think the curve flattens, and I think the long end is going to respond to the inflation indicators, which are well contained. I think the interesting thing about the Fed minutes yesterday, to talk a little bit about the short end, is they actually mentioned financial excesses for the first time that I've seen in a while. So it indicates to me that the Fed may be moving on the short end, regardless of the inflation anchor at 2% or therein. But the long end of the bond market is very, very cheap relative to international yields, and I think it's going to continue to attract assets and really allows U.S. investors to kind of de-risk their portfolios at a pretty opportune time. We've come up 180 basis points since the lows in the 10-year, and I think that stays in this range. I think the short end is going to get interesting if this financial excess and financial conditions and risk-taking mandate that the Fed seems to now have adopted takes hold. I think we may be in for a few more tightenings on the short end.
And the big piece in the Journal today is that investors are recalibrating what to do, and around the world as money becomes more expensive and it becomes less accommodative. And then you look at the last couple of weeks in equities. We were maximum, we were down 7% maybe from the highs after being up 45% or whatever average you decide to use, 35, 45 if you use the NASDAQ. So that seems like almost background noise. I don't know if that's anything to get concerned with yet, Elizabeth, or since it's not that much, maybe there's more to come to really reflect the change in central bankers' stance.
To a certain extent, it is a little bit of background noise at this point, but I think it's background noise that the Fed takes into account. We've definitely seen in their meeting minutes in the past where they do consider this kind of extreme equity market volatility as an input when they're considering the broader landscape. So I think when their November meeting minutes come out, people will definitely be looking to see, are they looking at this equity volatility? And so that's going to be something that's interesting to see.
That may be one of the problems with being outspoken, the president, in terms of Powell criticism, because even if he throws in a word, even if you see a little body language that he's less intent on following the dot plots, it's going to be, oh, he's folding. He's succumbing to pressure from Trump. So, I mean, there might be good reason for him to walk back some of his kind. You listen to Jim Cramer, there might be good reason to walk back some of his hawkish rhetoric, but he may be not inclined to do that, because it looks like he's giving in.
Right. I think there's very little upside.
I want to hear both. Let's let Elizabeth answer first, James, and then you can, because you seem hot to trot talking about that. Go ahead, Elizabeth.
I think there's very little upside in Trump criticizing Fed policy, but I don't think there's any risk from people who have been following Powell or this committee that they're actually going to base their policy around Trump's criticism. Well,
they might base it on the housing market or the lack of inflation, right, James? I mean, maybe he was a little bit too hawkish, just to look tough, to look different than Yellen.
I think the disconnect between what's happening with the Fed, to me, is if you look at the dual mandate and inflation, there's nothing in those data that suggests to me we should be continuing to tighten aggressively. I think the interesting thing, and I think you mentioned it, Joe, is that if financial markets and risk-taking become extreme in the Fed's eyes, that gives them additional justification for tightening. So this is the first year, 2018, where the markets began with a downdraft in stocks, if you remember, January, February timeframe, and the Fed probabilities of tightening barely budged. So the markets need to understand that the Fed put, the Powell put, doesn't exist, and risk-taking needs to be managed in accordance with the fact that the Fed is not going to bail out markets at this point.
But is that a surprise? I mean, everything you just said sounds like, yes, I agree 100%, but is there anybody who'd be caught off guard by that, or anybody in the market who would think, oh my gosh, I hadn't realized?
Well, it's the first time in the post-crisis period that we have fiscal stimulus, as you guys mentioned, taking over in terms of the economic policy versus the pure monetary side of things. So I just think that the markets and investors need to take heed of the fact that this is a very different environment. We have massive fiscal stimulus. We have budget deficits to deal with. And the easy money and the sort of macro trade that's been driven by very low interest rates and a deleveraging phenomena that could coincide with that is something investors really need to pay attention to. The inflation is well anchored. The long end of the Treasury curve is inexpensive relative, but leverage and cost of financing is going up, and that's going to show some where some of the risks are in the economy over the next couple of quarters.
So where do you expect in the next month or so, Elizabeth, in terms of support levels on the averages and how much work we need to do to, I don't know, could you actually say we put the correction behind us, or are we still, we're going to retest the lows and set some new lows?
I think we
for the
do still have
market,
some choppy trading.
Elizabeth, you're a fixed income guy. Let me get Elizabeth on the stock market. Go ahead, Elizabeth.
I do still think that we have some choppy trading and some volatility ahead of us because this does play out a lot like the February sell-off that we saw, where we did revisit the lows there. And we still have a lot of uncertainty in this market. We've got the midterm elections coming up. We've got a Fed meeting right after the elections where we're not really expecting a policy change, but I think people are going to be watching the Fed very closely to see what the language is in that policy statement. And then we're going to be looking at those minutes very closely as well. So I think we do still have some choppy trading and volatility ahead.